Hello, this is Gurvinder from Fixed Income Investment Team of Baroda BNP Paribas Mutual Fund. We are here to talk about the fixed income market, the recent developments, and how do we look at the interest rate environment going forward. We see the market from the lenses of the three hypotheses which were mentioned by the Central Bank of India, that is RBI, in one of its policies few quarters back. Those three hypotheses were domestic growth environment, domestic inflation environment, and global developments and its impact on currency markets. We try and interpret the same in the current juncture and then look at certain additional technical factors which may impact bond yields as well as entire interest rate curve going forward within the fundamental macro setup. The three hypotheses which are mentioned by RBI are domestic growth, domestic inflation, and global developments. We talk about growth first. India's GDP growth rate came in lower than expected in the recent quarter. GDP grew lower than even 6%. We read this GDP having some one-off exceptions in this quarter, but sequentially we hope to get 6% plus growth rate on a full year basis. This is likely to be on account of higher government capex plus recovery of the rural economy post a reasonable monsoon as well as agricultural output. Nonetheless, the GDP growth rate would likely be lower than RBI's full year forecast, as well as the run rate is lower than the long-term potential which was seen in pre-COVID years. So from a growth perspective, we are having slower growth rate, likely to recover going forward, but still potentially lower than the long-term potential which India was on pre-COVID basis. The second hypothesis which is tracked by RBI closely is inflation. The CPI inflation came in higher than expected in the recent month. Getting 6% plus run rate looks very scary from a headline perspective, especially when India is wanting to target 4% inflation. Major component higher inflation was mainly led due to food basket. The core inflation is maintained below 4% for consecutive months, even though it is slightly trying to go up from the low level we have seen for the bulk of this year. Having said that, for the full year 2025-26, which is next year, the base case is CPI inflation would most likely be around 4.5% plus or minus few basis points, with a potential downward trend if Brent prices, which have been remaining in a range for bulk of this year, move lower on account of increasing supply from US as well as continuation of slowdown in demand from countries like China. The third most important hypothesis what RBI has been keeping an eye on is the global developments and the uncertainties around it. We have seen in the recent past how the election results in America resulted in Trump trade and tariff trade. Dollar index got strengthened, and the consensus was the agenda of the newly elected president would be to look at American economy first and import higher tariff to make import costlier in America. This is being read by most market participants as potentially inflationary, and therefore bond yields initially started to rise in America. However, there is some silver lining in all this, is that the newly elected president and his chosen professionals have mentioned in various forums that they would want dollar to weaken in order to support their exports. They've also been mentioning about lowering the fiscal deficit, which has been one of the main problems from America. They would be adjusting that administrative and defense budgets and pave the way for fiscal deficit to be on an improving trajectory in America. but also on growth prospects in US as well as in the world economy. However, what is still uncertain about the tariff war which is likely to happen in 2025 is that it is not only likely to have impact on inflation, but it may also have a slowdown impact on growth numbers, not only in US but also in world economy, because overall quantum of international trade may get impact. This in turn could be positive trigger for bond yields. To summarize, amongst the three hypotheses, what we are seeing is the domestic growth has slowed. It might pick up again, but still remains lower than the potential growth rate. Inflation is volatile, mainly led by food component, but likely to be around 4.5% for the next financial year. Global uncertainties would continue and be part of the headline numbers for the full year in 2025, but the consensus expectation of higher dollar index, higher bond yields, as well as higher inflation in world economy is going to be negated by growth concerns also if the tariff war continues. See, apart from the fundamental factors driving the three main hypotheses which the central banks would be reacting to while deciding the policy rate environment, bond yields would also be looking at certain technical factors going forward which would play over and above the central bank's action. First technical factors which is visible in the near future is the potential debt ceiling limit which US economy is likely to face by the end of the year. Typically, when the debt ceiling limit is reached, supply of government securities in US comes down, and which in turn is bond positive. When US rates come down, it would have resultant impact on currencies as well and would be supportive for the continuation of FPI flows in the Indian market. The second and the most important factors affecting fixed income investor is central banks both in India as well as in US have maintained a fairly positive real rates environment. The 1 year T-bill rates in India is around 660, 665 level, and the expected inflation going forward is around 4.5%. So this 200 plus basis point of real rates provide a very fairly attractive fundamental reason to be invested in fixed income products. Similarly, the situation in US where the inflation expectation is around 2.3, 2.5% range and the policy rates are around 4.5%, providing cushion for the central bank to reduce rates if the necessary deterioration in the labor market. To summarize, we are at the peak of the interest rate cycle. There is hardly any case for increasing the policy rate from the Central Bank of India perspective. The central bank is likely to remain on a pause in the near future and then eventually embark on a rate cut cycle. We are accordingly invested at the higher end of the duration mandates in the respective products. We are also invested optimally in the spread assets, right from AAA to AA products as well as state government bond, because we feel the real rate coupled with the spreads available make it compulsive investment opportunity. We have seen in the recent month that even if there is no rate cut done by the central bank, the demand and the supply dynamics itself has brought in substantial reduction in sovereign bond yields. May not have happened in corporate bond, which means that the spreads looks very juicy as of now. Going forward, the key dynamics to be monitored are trajectory of dollar index has an impact on currency market such as India, the sustainability and continuity of FPI flows in India, especially on account of inclusion in bond indexing as well as potentially getting included in further indices, and domestic growth and inflation trajectory. All in all, from a top-down perspective, we believe the positive real rate environment itself is the biggest incentive to continue to buy on dip, if any, in the fixed income market. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.